Thanks for listening in today to this educational video for investors on recent changes to pension accounting. This is Chandy Smith, Senior Investor Liaison at the FASB, and joining me today is Marc Siegel, Board Member at the FASB. Welcome, Marc.
Thanks, Chandy.
So my first question is that the FASB recently made some changes to the accounting for pensions and other post-retirement benefits. What kind of companies do the changes impact?
So this would impact any company with a single employer pension plan or a single employer post-retirement benefit plan. So it's every industry that would be impacted.
So Marc, why did the FASB take on this project if pensions are reducing in number?
You know, although fewer than 30% of Fortune 500 companies still offer new and existing employees a defined benefit plan for companies that have them, these pension plans still represent a sizable financial exposure and are often pretty meaningful to reported results. According to S&P Global, at the end of 2016, the S&P 500 had pension obligations exceeding $2 trillion. There's also been a fair amount of diversity in how companies calculate and report pension cost, both in GAAP and non-GAAP results. And as you know, pension accounting is really quite complicated. Back in my analyst days, I'd often hear from buy-side clients that they had a quick question on pensions. But the truth really is there aren't any quick questions on pensions.
So true. So what's the issue that FASB wanted to address?
So all components of net pension and post-retirement benefit costs were being aggregated all together and reported within operating income in one fell swoop. Also, we know that sometimes these could be capitalized when those costs are related to production of a capitalized asset like inventory. The multiple components of the pension cost are required to be disclosed, which provides users of financials with good information about pension cost, although it's deep in the footnotes. So as a result of all this, investors and analysts who follow companies with big pension obligations, they could spend a good deal of time studying the components of pension cost. And many had said for years that several of the components of pension cost, like the expected return on plan assets and the interest cost in the obligation, those were distortive to operating income because they really don't represent the current cost of the benefit being provided to employees. But it's more like the cost of financing or funding the benefit. And so it really should be reported separately outside of operating income. Also, a bunch of companies over the years have moved more toward a mark-to-market approach for measuring the return on plan assets, while others have continued to set an assumption for the expected return on plan assets and use that estimate throughout the year. So that diversity has made it that much more difficult to compare operating results from one company to another in its peer group. It's also resulted in a bunch of non-GAAP measures for those who mark to market their plan assets to eliminate that market volatility from operating results.
Okay, so what are the changes made by the new guidance and the expected impact of the changes to fix some of these issues you're talking about?
So the change we made does not affect how the pension cost components are measured, but rather how they are presented on the income statement. And so this will impact the P&L, as well as key metrics such as EBIT and EBITDA, and really any operating-based metric. The change is really this. Only the current period employee service cost portion of the pension cost is allowed to be presented within operating income, alongside other employee compensation costs. All the remaining components of pension costs, like the expected return on plan assets, the interest cost on pension obligations, and the amortization of various pension amounts that are deferred from prior periods, all that will be presented outside of operating income, and it can be shown in one or more line items, but again, it's going to be outside of that operating income line. We also specified that gains and losses from any curtailments or settlements and certain termination benefits related to the pension plans will also all be shown outside of operating income. So you could see in our example on this slide that the $300 overall benefit being provided by the other components of pension cost are no longer included alongside other compensation expenses.
So are there any other impacts as a result of the new guidance?
So the board also made a decision that only service cost can be capitalized into assets like inventory or a self-constructed fixed asset. To the extent other pension costs were previously being capitalized into assets, those costs will now be immediately recognized, and as I mentioned, those will be recognized and presented outside of operating income.
Oh, that's an interesting change. Are multi-employer plan costs impacted?
No, the accounting won't change under the new guidance, as benefit cost for multi-employer plans is the employer's required contribution, as opposed to all the various actuarial components of the plan. I'm glad you asked about multi-employer, though. There's been some recent focus on multi-employer plans in the news and in Washington, D.C. lately, as many believe that these plans are significantly underfunded and are therefore at risk. And so we should point out that several years ago, the FASB began requiring more substantial disclosures about multi-employer plans. So definitely look through the most recent 10-Ks to make sure that you understand the risk, if any, for any of the companies you might be following.
Okay, good advice. So when's the guidance effective?
So the guidance on pension presentation in the income statement is effective for calendar year public filers beginning in the first quarter of 2018. For any non-publics or nonprofits, it's effective beginning in the first quarter of 2019. And this pension presentation guidance must be applied retrospectively, which means that prior periods presented will be shown under the new accounting. But that change to capitalization will only be applied prospectively, so going forward.
Thanks for all the info, Mark. And if those listening would like more information, they can consult the FASB website at www.fasb.org, click Projects, Recently Completed Projects, and select Improving the Presentation of Net Periodic Pension Cost and Net Periodic Post-Retirement Benefit Cost. Or you can always email me, Chandy Smith, at ccsmith@fasb.org.